In 2026, the smartest money in the world is moving quietly, but if you know where to look, the signals are impossible to ignore. Top hedge funds, the billion-dollar firms that manage money for institutions and the ultra-wealthy, are making strategic shifts that could shape the future of the global economy. And while retail investors often chase headlines, hedge funds tend to position themselves months or even years ahead of major trends. So the real question is, what are they buying right now? And why does it matter for you? Let's start with one of the biggest themes dominating hedge fund portfolios in 2026, artificial intelligence. This isn't just hype anymore, it's a full-scale transformation of industries. Hedge funds are heavily increasing exposure to companies building the infrastructure behind AI, including semiconductor manufacturers, cloud computing providers, and data center operators. These firms are the backbone of the AI revolution. Instead of betting only on flashy AI applications, hedge funds are focusing on the picks and shovels strategy, owning the tools that power everything else. This suggests they're playing the long game, positioning themselves for sustained growth rather than short-term gains. Another major area attracting hedge fund capital is energy, but not in the way you might expect. While renewable energy continues to gain attention, many funds are actually doubling down on a mix of traditional and transitional energy sources. Oil and gas companies with strong cash flows are still very much in demand, especially those investing in cleaner technologies. At the same time, hedge funds are selectively investing in nuclear energy and next-generation battery storage companies. This balanced approach reflects a key insight: the energy transition will take decades, and there's money to be made at every stage of that journey. Healthcare is also seeing a surge in hedge fund interest, particularly in biotech and precision medicine. Advances in gene editing, personalized treatments, and AI-driven drug discovery are opening doors to breakthroughs that were unimaginable just a decade ago. Hedge funds are targeting companies with strong pipelines and innovative technologies, often before they become mainstream. This is a high-risk, high-reward strategy, but it's one that has historically delivered massive returns when executed correctly. Now here's something surprising. Hedge funds are also quietly increasing their positions in industrial and manufacturing sectors. Why? Because of the global shift toward reshoring and supply chain resilience. After years of relying heavily on overseas production, many countries are investing in domestic manufacturing capabilities. This includes everything from advanced robotics to infrastructure development. Hedge funds see this as a long-term structural trend, not just a temporary adjustment. By investing early, they're positioning themselves to benefit from a multi-year transformation of global trade. Another critical trend is the renewed interest in emerging markets, but with a more selective approach than in the past. Instead of broad exposure, hedge funds are targeting specific countries and sectors that show strong economic growth, political stability, and favorable demographics. This includes technology hubs, fintech companies, and consumer-driven industries in regions that are rapidly digitizing. The goal here is clear: capture growth where it's happening fastest, while managing risk through careful selection.